Within the trading industry, there's a lot of importance placed upon entries, but it's actually one of the least important factors to being a profitable trader. So today I'm going to show you why and how to actually be very flexible with your entries so that it doesn't hold you back. So let's get right into it. We're going to be talking in terms of a bullish environment, right? So for bearish examples, just flip it around the other way. Now, let's say you're looking to get in a buy position, right? You're looking for an entry. You're basically saying that you're ready for price to run to the upside and target some kind of buy side liquidity. But before you get your entry, you're waiting for a lower time frame switch down here, which is where you'll get your entry, right? You're looking for price to turn from that sell program down into your buy zone, now into a buy program so you can catch the move to the upside. That's essentially what it is when we talk about your entry model. Now, that's perfectly fine. The problem arises when you see people preaching online about supposedly the best entry model or the only entry model you can use to be profitable, right? So maybe you see someone online talking about how breaker block entries are the highest probability, or how an inverted fair value gap has the best risk to reward, or how you can only really tell that price has turned around if there's a market structure shift. All these different entry types are promoted as the best and as the only way to do it. And this can lead you to having a mindset of you're only going to be profitable if you pick the right entry model. And this is very, very far from the truth. So I'm going to show you a better, simpler, and more relaxing way to enter your trades when I get back to this point. But first, let's talk about this. If you don't need to be ultra specific about what entry model you're choosing, then what is it that actually gives your trade a high probability of playing out? And it's actually the price action that happens way before it comes to taking your entry. So trading is simply a game of cause and effect, right? So when it comes to you catching that high probability expansion to a buy side liquidity target, that is simply an effect, right? That expansion you're looking to catch is an effect. Even the entry that you're taking is an effect of the price action that came before all of that. So if you're going to look to catch these high probability expansions over and over and over again consistently to be profitable, you need to focus on the cause of those high probability expansions rather than placing all your importance on the effect, right? You can't control an effect by controlling an effect. You can only control the effect by controlling the cause. So we need to look into what the cause should look like in order to get the effect that we're looking for. Does that make sense? So let's get into that. Now, there are three main things that make up the cause that will produce the effect of price running with higher probability to our target. Now, the first one is the higher time frame bias, right? So essentially, the best way that you can go about making sure you have clear higher time frame bias is just by trading in line with either a internal or external range liquidity target. So if you don't know what that is, essentially external range liquidity in a bullish example will be old highs, right? So you're going to want to trade in the direction of old highs if you're bullish, and an internal range liquidity target is an FVG, right? So if we're bullish, it's bullish FVGs. So you're either going to want to trade in the direction of old highs if you're bullish, or bullish FVGs, okay? That's it. If you're bearish, obviously just flip it around. You're going to want to be targeting old lows and bearish FVGs. So you're only going to trade in the direction of those two things ever. And the best way that you can go about doing this is by making sure the 1 hour or the 4 hour is already on its way there, right? So instead of trying to catch these little reversals here at the bottom, right? Let's say this is on like the weekly. What you want to do instead is make sure first that the 1 hour or the 4 hour is already building order flow towards that target, and then try and catch these lows within here, right? The same goes if you're targeting internal range liquidity. Instead of trying to catch this up here whilst the 4 hour and 1 hour are still bullish, you want to wait for price to actually switch that order flow and already be on the way down to the internal range liquidity, and then you can catch these highs up here at the top. Make sense? So that's what you want for the first step of the cause, right? You want to be trading in line with external or internal range liquidity, in line with the 4 hour and 1 hour. Now, the second thing is a liquidity sponsor. So before price can actually give you that run to your buy side liquidity target, right? Let's say you're targeting external range liquidity, right? Before price can actually give you this run to the upside, it needs a liquidity sponsor. Think of it like fuel for price to move, right? Like to drive a car anywhere, you need fuel, right? For the price to go to your target, it needs fuel. And to do that, it takes out liquidity, right? So let's say you want to see price run to the upside. You want to see it take out some kind of old low, right? It can be an old low on its own. It can be equal lows. It can be session lows, previous days low, months low. It has to take out some kind of low to induce people onto the wrong side of the market to get the liquidity sponsor to run towards your target. Without that, you have a very low probability of price running towards your target, right? So let's say that you're expecting this bullish run and you end up trying to take a trade here, right? Before price has even taken out an old low of any sort. There's no fuel for that move and it's low probability. So that's the second thing. You want to see price take out liquidity to get that sponsor so it has the fuel to run to your target. So the last thing you want to look for to have that high probability effect, that high probability expansion towards your target is timing. So let's draw this out again. When it comes to price running towards your liquidity target, right? There are specific times where price has a higher probability of doing that. I'm pretty sure I've made a video on this before where I included a bit more detail, but essentially if you look at either London kill zone, which when you see on my charts, it's a purple box, or you also look at New York kill zone, which you'll see is the orange box on my screen, right? If you were to go and study them yourselves, you will see that the majority of the time it's within these timings that price runs towards targets, and also within these times there's a high probability of price taking liquidity, right? So if we know we want to see price take liquidity and run towards a target, and it happens the most within those key timings, it makes sense to trade within those key timings, right? So those are the three things that you want to be placing importance upon, right? These three things are a million times more important than your entry could ever be, right? So you look for these three things and then you go for your entry. But enough of that. We're actually going to get into some examples so you know what this looks like. So this first example is on Euro USD. If you want to check it out yourself, it's on the 15th of January 2025. So the first thing that is way more important than your entry is the higher time frame bias. So in this example, you can see that price is bearish on the daily chart. Okay, price has been respecting bearish PD arrays. For instance, this FVG got respected and then price made a new low. And then this bearish order block got respected and then price made a new low, right? So we're making new lows, so the daily is bearish, which means if we go into target either external or internal range liquidity, we're either going to be targeting old lows or we're going to be targeting bearish FVG. So in this example, it's an internal range liquidity target, right? Because price has taken out this old low, which is external, and now is moving to the inside of the range to target internal, and we have this bearish FVG here, right? So we have the internal range liquidity target. The second criteria for the higher time frame bias is to make sure the 1 or the 4 hour is already moving towards there. If we go on to the 4 hour, you'll see that price is building bullish order flow towards that target, right? So you can see here price formed this bullish order block here, and then we respected that to the upside. So we're forming and respecting bullish arrays, which means the 4 hour is already on the way to the target. So that is the first step. The second thing that's way more important than the entry is the liquidity sponsor. So here we have a 4 hour FVG. That's the buy zone, and we want to see liquidity swept into that zone. So if we go on to the 15-minute now, right, first of all, you can already see we've had a fast and aggressive sweep beneath Asia's low here, right? So that's already taken out liquidity. And then we take out another old low as price taps into that buy zone. So now price has taken liquidity. So we have the fuel essentially for price to run in the other direction, right? To give us that bullish move. Now, the third thing that is way more important than the entry is the timing. If I put on London kill zone, you'll see that price has tapped into the buy zone during London kill zone, which is that purple box. So we know that we're operating within a high probability time, because like I said, there's a high probability that price is going to sweep liquidity and also target liquidity within this kill zone. So now we have the three main things that make up the cause of the high probability expansion, right? We have the daily bias, we have the timing, and we have the liquidity sponsor. Those three things are what produce the effect of a high probability expansion in your desired direction, right? So if I was to play this out now, you'll see that price runs to the target. And instead of focusing on the entry, which I'm going to show you how to do in a minute, and the expansion, you're actually focusing on the things that come before that, right? In order to be able to consistently predict this effect. One more example before we get into the entries. This is EU on the 22nd of Jan if you want to look at it yourself. The first thing that's more important than entry is the higher time frame bias, right? You can see that price closed above this level here, which is these last 4 down candles. They got closed above, that formed a bullish order block, right? So the daily is bullish. And in terms of targets, it's either going to be external or internal range liquidity in the form of old highs or bullish FVGs. And we have these equal highs here. So we have an old high / equal high target. And then we want to make sure that the 4 hour or the 1 hour is moving towards that target essentially. So you can see here on the 4 hour, again, this is the same bullish order flow from the last example. So price is forming and respecting bullish arrays. We respect this FVG and then we respect this bullish FVG. So we're building bullish order flow on the 4 hour towards that target, which is what we want to see before we move on to the next step. The second thing, again, that's more important than the entry, is the liquidity sponsor. So we have this 4 hour FVG here. That's the buy zone. So we want to see price sweep liquidity into that buy zone. Okay, so we're now on the intraday time frames. And if I play this out a little bit, you'll see that price aggressively sweeps out Asia's low, which is a form of liquidity, right? It's an old low. And we also have SMT here, right? Price failed to get beneath this low on Euro USD. But if we go on to the dollar index, you'll see that that is the same high as this one here, right? This is 11 p.m. and price was able to get above that. So then we have SMT at that level, right? So that essentially is a form of manipulation as well. So it's another form of a liquidity sponsor. So we have the liquidity sponsor. Now we essentially need the timings, right? Again, if I put on London Kill Zone, you'll see that London Kill Zone opened up here, right? This purple box. So we're within that key timing where price has a high probability of taking liquidity, which we've already done, and then running towards a target, which is essentially what we want to catch. So again, we have the 3 main things that make up the cause of a high probability expansion towards the target that are way more important than the entry. You may have also noticed that these 2 case studies are perfect examples of London protraction cycle. You can see in this one, we took out Asia's low aggressively. Now we're looking to catch London to the upside. If I go back to that example from the 15th of Jan, again, price has taken out Asia's low. And now we're looking to catch London to the upside. Perfect examples of the London protraction cycle. So if you want to think about it in daily cycle terms, when we talk about the timing, essentially we're just looking for a daily cycle. So now it's time for me to show you a simpler, better, and frankly more relaxing way of thinking about your entries rather than sticking with one entry model. So once you have the cause, right, you have those 3 things already laid out. Now it's time for the entry. So you're expecting price to run to some kind of liquidity target, right? So we need to be able to get in a position down here. Now the best way for you to do that is to simply identify a switch in order flow, right? So price would be moving to the downside into your buy zone to take out that liquidity. Now you need to see the order flow switch in some kind of way before you can get your entry, and then you'll enter and ride the move to the upside. Now the best way to go ahead and actually spot this switch is by looking for price to form new PD arrays. So in a bullish example, price would have been respecting bearish PD arrays towards your buy zone. So you'll see the switch when price starts to form bullish PD arrays instead. Okay, so for example, over here, price starts to form a bullish order block, right? So we form a bullish order block. We're starting to form bullish PD arrays, which shows that the order flow is switching. Now, you may or may not have noticed, but if I was to draw out a lot of these entry models that are preached about online, right, and they're said to be the best way. So like, for example, a breaker block, apparently the best entry. A market structure shift, apparently the best entry, right? And then what other ones are there? An inverted fair value gap. Again, according to some people, is the best entry, okay? But the truth is they all work, right? Because what do they all have in common? They are all creating a new PD array, right? This one, we create a breaker block. This one, we create an order block. This one, we create an inverted fair value gap. You know, the list goes on. Maybe you make a fair value gap. Maybe you form a mitigation block. It's all the same thing. Price is forming new bullish PD arrays. So the fact that people say one of these is the best is simply flawed, because it doesn't matter. All that matters is the fact that price is forming a new bullish PD array, okay? So when it comes to you navigating your entry and you see price form an order block, take the trade. If you see price go ahead and form an FVG, right? If we go on to the 15-minute here, price then forms an FVG, right? Take the trade. If I play this out again, you can see that price forms a bullish propulsion block, right? Take the trade. It's just new bullish PD arrays. It doesn't matter which one you pick. The point is price has switched the order flow to bullish, okay? You did the work of getting the 3 building blocks that create the cause for price to run aggressively with high probability to your target, okay? So when it comes to the entry, it doesn't matter what entry model you use. All you need to worry about is, has price switched the order flow, right? So you can see here, the switch in order flow was the formation of this bullish order block. I personally entered off of that, right? So I entered here. I'll put the execution on the screen, right? But that doesn't mean that is the only way to enter, right? That is not the only entry model that you could have used. I know someone that also took this trade, but instead they got in off of the FVG instead, okay? And then after reviewing the trade, I was looking at it and I was like, oh, I could have actually scaled in and taken the propulsion block, okay? So it doesn't matter. It really does not matter. Just look for the switch in order flow and make sure you have the 3 main building blocks that give you the high probability expansion, and you will be absolutely fine. You have a high probability win rate. If I play this out, you can see price runs to the target and you would have been fine no matter what entry that you have taken. These 2 case studies I've just gone over utilize the exact same model that I use in every single trade that I take. This trading model can be broken down into 4 simple steps, and I've put those steps into a PDF document you can get completely for free. For you to get access to it, all you have to do is click the link in the description, and you'll also find below that a link to my free Discord where I actually called out this trade beforehand, right? So you can get access to that completely for free as well. I hope you found value in this video, and I'll catch you in the next one.